Welcome back to the Investing on the Go podcast, brought to you by FundCalibre. We're focusing on the complexities of Japanese equities this week, exploring everything from the market's oscillation between growth and value stocks to recent corporate governance reforms and the weakening yen.
I'm Chris Sarley, and today we're joined by Karen C., manager of the elite-rated Baillie Gifford Japanese Income Growth Fund. Karen, once again, thank you very much for joining us.
Thank you for having me.
Let's start with investment styles in Japan, because it's known for its wild swings between sort of growth and value markets. For listeners, maybe just explain where we are in the cycle at the moment, and are there any signs of what direction it might continue to take? And that's the first sort of layer. And then secondly, the implications for your fund.
Yeah. So over the last 18 months or so, I think it's fair to say that the market's attention has firmly been on the sort of large cap value stocks in Japan. Now, there are a couple of drivers for this. One is quite a violent recovery for some of the cyclical stocks in the market. They tend to be quite large index constituents. We're looking at sectors like sort of auto industries, sea transportation, such as like shipping companies and mining companies, coming out of the sort of COVID disruption. It kind of caused some of these cyclical recoveries to be quite, as I said, violent over the last 18 months. Some of it is caused by the weaker yen. The yen, it currently is at its weakest in about 3 decades. Again, some of these sort of cyclical names, particularly exporters, they benefited heavily by having a very weak yen. So that has captured the market's attention and focus. But there's also one other thing that's happened over the last 18 months, which is the head of Tokyo Stock Exchange came out and pretty much said companies with below 1 times price to book valuation, they need to do better to create better values for shareholders. And if they don't see any improvement, then they're pretty much going to go down a name and shame route, which is kind of a list of companies that they think is not doing good enough for the shareholders. Now, Japan has a very consensus-driven culture. The last thing you want to do as a listed company is to be picked out from the crowd, be labeled as bad. So what that means is there's been a lot of focus put on companies that traded below book, as the head of Tokyo Stock Exchange has decided to use these metrics to sort of categorize whether you are doing a good or bad job. And there's been a flurry of initiatives announced by management, sort of ways in which they can sort of air quotes rectify the low valuation. And we can see that in terms of more dividends paying back to shareholders, unwinding some cross shareholdings, buying back more shares, cancelling treasury shares. These are things that have happened for a while now, but there's just a lot more urgency behind these. So it calls that part of the market, so companies traded below books, that again also happen to be sort of the larger constituents of the index, what we typically consider to be sort of value stocks, to have done very well, because people kind of just think that there is a lot of low-hanging fruits that can be had in that space. What it means for our fund, so for listeners that don't know us well, we are bottom-up long-term growth stock pickers. So we typically go out and try to find companies that they have a very exciting growth prospect in front of them, and that they have the ability in terms of the edge of the business, management quality, financial resilience, to really execute on that opportunity well. So a lot of the areas that have caught the attention of the market over the last 18 months or so are really not what we typically would find attractive. And so this fund has therefore, as a result, faced quite a challenging period investment performance-wise. But what it has created over the 18 months of sort of focus on a lot of these value stocks is that we are now able to find growth stocks that we generally do think about and invest in at much more attractive valuation than before. And we believe that actually going forward the next sort of 3-5 years, the sort of asymmetry of returns is much more appealing for us. We can buy them with lower multiples. Their sort of structural growth story is still intact. So that's where we are now.
I'm going to come back to the structural growth stories in a bit, but there was quite a lot in there that I wanted to follow up on. Firstly, you talked very early on there about the yen. It's been battered and a source of concern for lots of foreign investors. Maybe just explain where we are in the cycle in terms of the yen, and do you see it stabilizing, and a bit of a view on that, please?
Yeah. So we don't have any currency views, and it's not something that we spend a lot of time thinking about, to be very honest. But one observation that I would offer, which is a very obvious observation, is, as I said before, that the yen is at its weakest point in over 3 decades. So as a sort of generalist investor who don't necessarily have at the edge, thinking about macro factors or to be able to predict when these things might change, what we are thinking about is, well, if we are in quite an extreme position when it comes to the yen's valuation, how that has impacted various portfolio companies and also market constituents in terms of their profitability, the resilience of the business. So you're finding that, if you have a business that profit has just been shooting the lights out, but then a lot of that is because of a translational effect in the currency, that might not actually be something that you want to put a lot of weight on. Whereas if a company, despite having quite a weak yen headwind, they might be domestic player, so they don't really have much benefit in terms of exporting. The cost has increased massively because of the weak yen effect, but they are still doing very well, and in some cases actually, relative to their competitors, they're in a much stronger position. Then that might actually catch our attention in terms of thinking harder about, well, when and if things do normalize in terms of the currency, then these companies might start to look quite interesting. We don't know when that will happen. Wouldn't really be making any predictions about that, but I guess it's more sort of observing that it is at quite an extreme point at this particular point. And I think a more sort of tangible sort of observation that when I was out in Japan, the kind of prices that as a tourist you'd be paying for like a lunch is like under tenner for a 2-course lunch in central Tokyo. Now this is great for a tourist, but for someone who lives in Japan earning domestic wage, this is quite a difficult reality in terms of how much the yen has weakened. So that might cause some kind of other effect in terms of the domestic consumer, how much they can buy and how they will change the consumption habits as well. So there are a lot of sort of like second order effects they need to be thinking about. So those are the things that we're thinking more of.
Okay. I wanted to touch again, then you mentioned on corporate reforms a bit earlier. They've been ongoing for a number of years, but you talked about the One Times book as an example of how things have changed more recently. Could you maybe give us an example of how those recent changes have impacted your portfolio specifically?
Sure. So in our portfolio, we have a few holdings in the sort of financial sector. It's been great owning them because they have quite a strong run over the last 18 months. The investment case, this is not the only sort of investment case for some of these companies, but one part of the investment case is that actually some of these companies are sitting on a lot of cross-shareholding. So non-life insurers that we own in the portfolio, because of the sort of corporate history in Japan, there's been a lot of, when you do business, you kind of own some shares in your customer's company. So then you kind of like deepening your sort of customer relationship, and then you kind of have each other's back when you do business. And that might sound good when you're trying to win the business, but on a whole, what that has created is quite a sort of cozy corporate relationship where managers are not being held accountable for the corporate performance, because if you have your mates basically assessing your your performance. Even if you're not doing a great job, they're not really going to vote against you. So it's not a very effective system. So as part of the corporate governance reform, one of the things that's been really pushed hard on by regulators, and actually they come out and have mandated the unwinding of these cross shareholdings. What that has meant is that a lot of these cross shareholdings has been sitting on the balance sheet at perhaps book value. They now have to be sold and unwind as a result. And what the company then do with this huge amount of cross shareholding that they're unwinding is then interesting. Now they would go out and buy back some of the shares. And then actually there's been quite a few chunky share buyback announcements from our portfolio companies. They will increase the dividend payouts, but also they would invest back into the business. So this is where picking the right one can be quite important, because you want the management to continue to think about where they can grow the business and actually allocate the capital effectively. And so we have seen a few of these financial holdings in our portfolio done quite well on the back of that. It's not just in the financial companies, though. There's been quite a few other companies that have not announced the share buyback in decades that have come out and announced that. And that would obviously have been good for the share price performance. So that would be an example.
I was going to ask, is there a good example of a company outside of the financials that's done that you could think of?
Well, so this one might be a bit controversial, but SoftBank is one that actually has done a huge amount of share buybacks over the last couple of years. And our core investment case in SoftBank is that we believe that Mr. Song is actually one of the best capital allocators in Japan. Now, many people have their opinions about SoftBank, and this is actually one of the reasons why there is a potential investment opportunities here, because people tend to focus on a lot of his investment failures, whereas the successes don't really make the headlines as prominently as his failures. So people kind of look at him and think, oh, look at the rework and all these other things that he has failed. But then what has really made SoftBank in terms of the value creation, his bets on Alibaba, and then he successfully sort of exited it and then kind of put money into AI. I mean, more recently, ARM has driven SoftBank share price I think to probably one of its heights since listing. Again, this is because Mr. Song has been very shrewd in terms of like thinking about the long-term opportunity, where to put capital. But because he's such a shrewd capital allocator, he understands when his business is undervalued, and therefore he opportunistically do share buybacks. Not because the head of Tokyo Stock Exchange come out and tell him to do so, but because he believes that is the best way to use capital. Now, interestingly, sorry, maybe going slightly off topic, but one of the activist investors in SoftBank has recently kind of asked him to do some more share buybacks at this point. But then he actually quite straightforwardly kind of responded, no, actually, at this particular point, I think more investment in AI would generate more shareholder value in the long term. And I think this is the kind of thinking that you want the management to be having, not doing share buybacks just for the sake of doing so, but because that is the best way for allocating the capital, because your business is undervalued. Now, if your business is not particularly undervalued and you go out and do share buybacks, that's actually value destructive. So that is some of the worries that I have with some of these sort of blanket kind of go out and just sort of do all the paying out dividends and share buybacks regardless of whether it makes sense or not, is that actually sometimes the timing might not be right. You don't want to kind of every year go out and buy shares that is not just going to automatically increase shareholder value. So kind of having that understanding in management is very important. And I think some Japanese companies, they might still not be thinking about it from that perspective, but it's more from they wanting to protect the reputation and not wanting to be kind of pulled out and name and shame, and therefore doing it that way. But nevertheless, going back on track of the sort of corporate governance reform, I think a lot of the the low hanging fruits are being addressed by companies, and the good thing that comes out from all of these reform. And this is a long time coming reform as well. It hasn't just happened over the 18 months, even though this is time period in which people started thinking or paying a lot more attention about corporate governance reform in Japan. It's actually been going on for more than 10 years since the Corporate Governance Code and Stewardship Code came into effect in Japan. And even before then, there's been also efforts to try to improve a lot of these things. So I guess my point is the more interesting change coming from all of this corporate governance reform is to do with how management changes the way they think about capital allocation and utilizing the balance sheet well, and not just kind of running it because Japan has been in deflation for a very long time. Mm-hmm. So they haven't had that prompt of you need to make sure that you're putting the money in the right place so that the value doesn't go down. So they have kind of become quite lazy with balance sheet management. That's changing now, which is good. But there's still, yeah.
I was just going to ask you said that there. I mean, let's move on to the obvious question, which is how they allocate. Obviously, historically, dividends has not been, how should we say, sort of, it's been sort of fairly, compared to a market as mature as the UK, it's not sort of as sort of widely used as a tool, but that obviously has changed. You've got many more companies that do pay dividends. Could you just explain, has that change been steady? Has it accelerated with the recent changes? I mean, maybe give us some numbers behind that. How what sort of universe of companies do you now have now versus maybe, I don't know, 5 years ago in Japan?
Yeah. So it has been a gradual change. If I were to pull up a graph for shareholder returns in terms of dividends and share buybacks over the last sort of 20, 30 years, you will see a very steady sort of upward trend from sort of the bottom left to top right type thing. Even though there would be a bit of an uplift sort of over the last couple of years, that is to do with the TSE, sort of Tokyo Stock Exchange initiatives, sort of pushing that a lot harder. But like I said before, this has been a long established trend. Definitely, the regulator's been kind of going quite hard at it for over 10 years. In terms of numbers, though, I'm just trying to kind of see if I can read out anything. So the total amount of, say, dividend paid out to shareholders, sort of, let's say we go back to around 2011, 2012, it will be under 10 trillion yen. Mm-hmm. Whereas if we look at sort of the last year or so, the amount sort of being paid back to shareholders would be over 25 trillion yen. So that's quite a magnitude of difference. Now, some of that is to do with companies who are actually making more money, more profits, but then also in terms of the proportion of earnings coming back to shareholders in terms of dividends would have risen, but then a lot of that also comes from balance sheets. A lot of cash been sort of sitting on balance sheet, not really being utilized, and that has been gradually paid back to shareholders as well.
And is it fairly spread across the market cap, or is it mainly the big players that contribute to that 25 trillion?
Definitely the larger players will have more impact. And you tend to find that if you kind of it's sort of just the mechanics of cash holding. If you've been around for longer and have a business for longer, that you actually have longer period to kind of hold more cash, so you can then unleash back to shareholders. When you look at sort of smaller, mid-sized companies, they tend not to have as much cash as the larger players. And in some cases, if you kind of think about a really large companies, but don't necessarily have avenue to invest for growth, then the obvious thing to do is to pay back more in terms of dividends. So I would think that the larger companies have also just sort of logic that they will have a bigger impact in terms of moving the needle in terms of the total absolute amount of dividends being paid back to shareholders. But for us, what is also important is finding companies that can grow that dividend stream. So it's not about finding the ones that have a lot of cash on the balance sheet that can kind of pay out a couple of times. And then once you kind of get to the end of that, there's nothing else for you to kind of be excited about. Whereas if you can identify a company that genuinely has a growing sort of earning stream, and they also don't need all of the capital to continue to have to be reinvested into the business, they can see the dividend stream coming back to shareholders actually rising over time. Like that's more exciting and interesting for us.
Okay. I wanted to touch on a couple of themes quickly. First one is that Japan is sort of well known for those sort of robotics and automation stories, and market leading in a number of those areas. I mean, just maybe give us a bit of insight into that. Obviously, you have almost half the fund in the manufacturing sector, and I know that looks a bit different to what people might see here in terms of what that sort of includes. But maybe just give us a bit of insight into that. Is it all going towards AI? Is it quite a spread out story in terms of robotics and automation now?
Yeah. So I'll tackle the half of the fund being exposed to the manufacturing sector question first. So the way that sort of the topics that the index sort of categorize different sectors, sometimes it's not very straightforward. So even though it might say manufacturing sector, but actually underneath that, it captures a lot of different themes and types of companies. So for example, within this 50% exposure to manufacturing sector of the fund, it captures companies that make skincare products, nappies, crisps, even sort of medical precision devices. So not all of that will be automation and robotic exposure, but automation and robotics, they are a key theme in our portfolio, because we believe that actually going forward, the demand for robotics and also automation would only accelerate. First reason for that is because if you look at sort of Japan's demographics, like they need more automation in order for the society to function. And that has actually, I think, helped some of these automation companies in Japan to flourish over time, because society as a whole, when you don't have this debate over are they stealing our jobs, is much more easily and readily embracing of automation technology. Now, these automation companies historically have benefited from quite a strong auto sector in Japan, who then adopt automation technology. But looking forward, we can see the automation being rolled out into other sectors as well, not just cars or making of cars. And Japan is in quite interesting position sort of geopolitically, if you kind of think about the experience of COVID, how a lot of the sort of manufacturing companies, even governments might be thinking about the resilience of their supply chain and what they might want to do in terms of bring back some of that onshore. A Japanese automation company, you can see it's quite straightforward pick, as in if you want to automate the manufacturing facilities to be closer to home, would you want to pick a robot is made by a Japanese company, or otherwise it's quite an interesting play from that particular perspective about resiliency of the supply chain. So this is a key theme for us.
You mentioned robotics and automation. There's a whole stream of things that sort of come to mind there, but perhaps one of the things that sort of slip through the net, perhaps when you think about this, is digitalisation. That's perhaps not a story that's you maybe think with the other sort of areas like robotics and automation that would come along as well. That's perhaps the likes of e-commerce, cashless payments, online banking, investing online. That has lagged when you think about it, and it sort of looks a bit stark when you consider some of the other areas that Japan excels in. What is the underlying reason for that? Is that the demographics? Are there any other reasons beyond the demographics for that? And are you seeing that change? And are there examples of companies that are sort of leading that change in your area?
Yeah, this is always quite a curious thing, and also surprising thing as well for people that don't know Japan very well, because people tend to think of Japan and think of these like robots and like super technologically advanced. But actually, it's not even that long ago. I think it was 5-10 years ago, they were still using fax machines. That you can go into a convenience store and then they will have fax machines there in case you need to use that for whatever reason. So I don't know what are the precise reasons as to why they've been so slow with the digitalization of various things. But it's certainly something that is much more front of mind for companies and management now because of labor shortage and how acute labor shortage is in Japan. It's not a question of, oh, it's a nice to have, we can digitalize this. We need to do this. We genuinely want to be able to continue our business because we don't have enough people to continue doing accounting sort of like on paper or even a very basic Excel spreadsheet. We want something to actually get done as easily and with as few number of people as possible. So from a growth investor's perspective, Japan is quite an exciting place because it almost has been sort of it sits inside its own little bubble in the sense that it has all of these. It's certainly a very wealthy country still, but then for whatever reason, it's not been heavily digitalized in terms of a lot of the functions, whether it's sort of within industries or just generally sort of how business operates. So you can see the trajectory in the adoption going forward, particularly when it's underpinned by labor shortage as to why there will be a rise in demand for these things. So we're seeing things like digital payment, for example. That's really the adoption for that really got accelerated during COVID. And that is one of the also investment themes in our portfolio. Whether it's looking at digital payment in terms of online digital payment or even just physically when you go to a shop, you're able to pay with a credit card, not having to walk around with a pile of cash anymore, even though you might still have to if you go to more rural places in Japan, but is one of these things that is definitely changing in Japan. Online banking is another one. Japan historically, the banking industry has been quite sleepy. There's need to be more digitalization happening in the back office to help kind of streamline some of these processes. Seeing opportunities also within the sort of e-commerce space. A lot of these things that you can kind of just look around you, say in the UK, where actually e-commerce adoption is quite high. Digital payment also, you kind of think about, well, why wouldn't Japan kind of head towards this direction when they have such structural issues when it comes to labor availability. So it's an area we're finding a lot of fruitful investment opportunity currently.
I was just going to ask just briefly, is there one example that maybe you could give us of some of a company that in the portfolio that sort of is tapping into that digitization trend at the moment?
Yeah, the one that I will be thinking of actually in terms of digital payment might be one of the more obvious trend would be Z Holdings. It has a subsidiary called PayPay, which is a QR code payment thing. So if you think about when you go to a shop and you pay currently, you tend to have like a thing that you can tap your phone or your contactless card, but actually for some of the smaller merchants, that might still be quite expensive. So having just a QR code where you can ask the customer to scan with the mobile phone and therefore able to transact that way is a easier, lower hurdle in terms of adopting some of the digital payment methods. So PayPay is the leading player within that, like pushing the digital payment story in Japan.
I wanted to finish on Outlook. A little earlier, we talked about you talked about some of the challenges and the structural growth opportunities that you were seeing now. Japan's obviously had a good 18 months in general. Maybe just talk about the opportunities you're seeing for your perspective, and then maybe just whether that run can continue or whether it sort of morphs into a run that sort of benefits you on your fund specifically.
I certainly hope so. Well, so as we sort of discussed, like the good run over the last 18 months, some of them were driven by quite specific macro factors. And while this fund has not benefited as much from these macro factors, we actually now at a point where for the type of businesses that we sort of specialize in looking at and investing in, they are looking more and more attractive. Their symmetry of returns is really looking very good if you don't have to pay so much, but then you actually know that the growth story is still intact. Now, it's very difficult to predict cycles generally. Whatever cycle that might be, it might be the yen, it might be the whatever industries these companies tend to operate in. But there are things that don't change, and those are the structural trends we see in Japan, and those are the things that we spend a lot of time thinking about when trying to identify investment opportunities. A lot we've touched on automation, digitalisation, opportunities that can be created by the labor shortage issue and demographic issues in Japan. Those are not going to go away. So these are the things that we continue to think very hard about to find investment opportunities over the long term. When the market's going to turn, I don't know. But I think that given where the valuation is at the moment with a lot of these growth stocks that at times you hardly have to pay much premium for it at all, is looking really rather interesting. And I think also Japan, in terms of as an asset class, is also quite interesting because as it has demonstrated over the 18 months, it's driven by its own idiosyncratic drivers. It has its own stories. And so if you want to put something in a portfolio that's a bit more uncorrelated to everything else, actually Japan is quite a good place to look for now. The drivers for the next sort of 18 months might be different to the last 18 months, but then at least if you look at our fund, we're kind of looking very specifically at this economy that's a slightly different point as other developed markets that are facing its own issues. And then therefore the set of companies that would benefit would also look quite different. So I think Japan continues to be a very interesting and fruitful place for people to consider and to think about. And I certainly hope that it will be a much easier time for growth investors over the next couple of years than we have experienced in the past couple of years.
On that note, Karen, thank you very much for joining us today.
Thank you very much for your time.
As discussed through this interview, the Baillie Gifford Japanese Income Growth Fund aims to benefit from the improving corporate governance in Japan as more and more businesses move towards a progressive dividend-paying policy. To learn more about the Baillie Gifford Japanese Income Growth Fund, please visit FundCalibre.com. And don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts. Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.